There is a risk here that we rerun 98, 99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fall. So I think it is not a small probability that we have a really blow-off kind of next 9 months or so.
The world is on the edge of a major shift, not into crisis, but potentially into one of the most powerful market rallies we've seen in years. According to macro investor Raoul, the geopolitical landscape could be on the verge of a rare moment of calm. Imagine a ceasefire in Ukraine, a breakthrough deal between the US, Saudi Arabia, and Iran, and a cooperative pivot from China. If even two of these materialize, Powell believes the market will have effectively eliminated its major left-tail risks, the kind that usually keep investors up at night. And what happens when fear evaporates? The answer, says Powell, could be explosive. With tail risks off the table and inflation continuing to trend downward despite the headlines, there's a growing chance we're about to enter a blow-off top, a parabolic melt-up in both equities and crypto markets driven not by fundamentals, but by narrative, liquidity, and pure momentum. Powell sees signs of this building already. Positioning remains light, sentiment is skeptical, and liquidity is quietly being added to the system. That's a perfect recipe for a sudden vertical move. It's not about slow and steady growth anymore. It's about what happens when everyone realizes at once that the downside has vanished, and they scramble to re-enter risk assets. In this video, we dive into Raoul Pal's most recent interview and break down why the next 9 months could be unlike anything we've seen since the post-COVID bull run. Stay tuned as we explore the macro setup, the potential for a banana zone repeat, and what it all means for crypto, stocks, and your portfolio. And before we begin, don't forget to like, subscribe, and hit that notification bell. It helps us grow and keeps you updated with the latest market insights. Thanks, and enjoy the video.
So, what I've done is built that framework of how crypto is just a macro asset. And it took a long time for people to believe that. They thought it's something different, it's something unique. It's a macro asset. So you apply the same things that I've always used, which is liquidity, business cycle, all that stuff, plus a bit of technicals and sentiment. There's no voodoo here. It's pretty straightforward as an asset. It's just more volatile. So it's harder to deal with. But you were right. What I was seeing was like the liquidity indicators like Global M2 had stabilized and started going up. It leads Bitcoin. Bitcoin was following it almost perfectly. So I was starting to look for the bottom. Then I start looking at stuff like, okay, where's sentiment on NASDAQ? Because it's tech stock, same thing. It was in the gutter. Right. Sentiment was the worst I had seen since COVID. That was across the board, across everything. Even hedge fund long short, everybody was max bearish. And I'm looking at liquidity. It's going up. I'm seeing the market getting fearful over a narrative. And I'm like, well, what is the likely outcome here? Are they going to have 150%, a trillion percent tariffs on China? No, they're going to reach something normal. So you've gone from peak headline fear to things could only be better from here. So for me, it was like a no-brainer of an opportunity, both in tech stocks and in crypto. And so going forwards now, normally speaking, this is the period, my framework is about, them rolling the debt and having to provide liquidity to do so. Mm-hmm. And so what we've got is a lot of forward-looking liquidity coming out of whether it's the weakness of the dollar, whether it's other countries using their balance sheets, a number of different mechanisms. And all of that to me is suggesting that the rest of this year is going to be very strong. And I was kind of thinking the NASDAQ was going to be a V-shaped recovery. And my God, it was a V-shaped recovery. And people are still underweight and short. It's like, it's a hell of a setup. We overlaid the chart of 1997, the Asian crisis, was a short, sharp shock, versus now it's almost identical. The 4-month period leading up to it, 4 or 5 months leading up to it. And that was a V-shaped recovery as well, because everybody was caught off sides because they thought the world was going to end. Liquidity came into the system. It was via the Fed that time cutting rates. and all the other central banks, and the market just went up in a straight line for the next 2 years. There is a risk here that we rerun 98, 99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fall. So I think it is not a small probability that we have a really blow off kind of next 9 months or so. The last Trump cycle in 2017, where the same thing, the market corrected in the beginning because everyone's fearing tariffs and the same narrative. The Fed were raising rates and doing balance sheet runoff. And the market screamed higher all year because the Chinese were stimulating, the Europeans had to stimulate. So it feels like, even if the Fed don't do anything, I still think the Fed cut, but let's assume they don't. Well, that's not a prerequisite for the market to do anything. As you said, as long as rates aren't jacking higher, everything's fine.
While mainstream narratives remain fixated on inflation risks and geopolitical instability, Raoul Pal offers a sharply contrasting view grounded in macroeconomic indicators and capital flows. He argues that crypto, often misunderstood as an isolated asset class, is in fact deeply tied to the same forces that drive global equity markets: liquidity, sentiment, and the business cycle. When those levers move, crypto reacts, often with greater volatility, but also greater upside. According to Pal, the liquidity backdrop has already begun shifting. Global M2, a broad measure of money supply, has stabilized and turned higher. Historically, this has been a leading indicator for Bitcoin and risk assets, and once again, Bitcoin's price action appears to be closely following that trend. Simultaneously, sentiment in tech and equity markets has remained deeply bearish, even as asset prices recover, creating a powerful contrarian setup. Hedge funds, institutional portfolios, and retail traders alike have remained underexposed, missing the rally in both crypto and US equities. The result is what Pal describes as a no-brainer opportunity. With forward-looking liquidity quietly increasing, fueled by a combination of dollar weakness, central bank interventions abroad, and ongoing debt rollovers, markets are positioned for continued upside. He compares the current environment to the post-Asian financial crisis recovery in 1998 to 1999, where a V-shaped rebound caught investors off guard, launching a 2-year bull run driven by surprise central bank easing and improved global coordination. Crucially, Pal emphasizes that the current rally isn't predicated on the Federal Reserve cutting rates, although that remains a likely tailwind. Instead, it's the absence of further tightening and the dissipation of macro fears that's allowing risk assets to reprice aggressively higher. From his vantage point, we are only in the early innings of a full-scale restocking of US equities and crypto allocations, a process that could last well into next year, especially if geopolitical risks resolve and inflation fears continue to fade.
No, it's real, and I'll tell you why it's real. I've just come back from the Middle East. All of the sovereign wealth funds are now buying. Right, these are the largest pools of capital in the world. We're hearing it out of Saudi, out of Abu Dhabi, out of Qatar, and out of Bahrain. And why that's happening is because the US has become crypto-friendly. It's the green light. So the US will get some regulation through. There'll be a bit of a shit show and debating about it and the usual stuff, but they will get some regulation through, which is the clarity that all of the pension funds need. So they're waiting as well. So there is a lot of buying to come from the really big players who've been waiting. Like Goldman has not been able to fully build out its desk, and JP Morgan haven't. They've had crypto for a while, but only for certain types of customers. But they want to build out suites of product, but they've been waiting for regulatory clarity. So yeah, I think it's a big deal. Like, the institutions are still either trying to figure out what this thing is. Yeah. Right? I had a conversation with one of the biggest kind of financial asset management firms in the world yesterday, based out of the US. And they're like, They've even got a crypto division, but they're other kind of where they allocate the assets. They're like, we don't know how to deal with this. So they're still trying to figure out what it is.
Yeah.
Like they haven't figured out it's a macro asset. Others have. The sovereign wealth funds obviously are just doing it for diversification of reserves. They're like, it's a technology, it's a diversification of reserves. So if the US is going to do it, we're going to do it. So there's different groups doing different stuff. There is a bunch of people who still don't really want to do the homework on it. They're like, we don't know, it's too volatile for us. But I think usually it's the first mover advantage in this. And, again, it reminds me a lot of back in the day when Goldman rolled out the GSCI index and nobody had commodities in their portfolios. And that team had to go around and sell commodities to everybody. And they would say, the clients would say, but it's too volatile. And you say, yes, but right. Part of a diversified portfolio, it's exactly the same thing, right?
That's right.
It's right. Exactly. And also, we were around when the gold ETF started, and it's the same thing. Everyone was like, holy shit, where did this come from? It became a very, very big ETF. It's exactly the same. What people like to do, because there's so many new participants in the industry, they think it's all new and different. When you've been around as long as you and I, you realize nothing is different. We've gone through all of this before. This just happens to be a bigger, faster moving asset, but it's the same as GSCI was. It's the same as the gold ETF was. It's the same as the NASDAQ was when we didn't understand what the it was and why it went up all the time. It's all of these things combined, right?
What do you think about gold here, Raoul?
So I came up with something, it was only last month in Global Macro Investor that kind of shocked me, hadn't figured out, is that there is a set of dominoes that happen in markets. Financial conditions lead everything. For financial conditions, we use the dollar, rates, and oil, right? The three big financial conditions thing. What we found is that leads like the ISM and other stuff by about 9 months. And it leads liquidity by about 6 months, something like that. Liquidity is what drives Bitcoin and NASDAQ, and it leads it by 3 months. So global M2, let's say, leads Bitcoin by about 3 months. I found out, I was like, what's going on with gold? I put it against against financial conditions. It reacts in real time to financial conditions.
Wow.
I'm like, holy shit, why didn't I figure this out before?
Of all trading securities, right?
Of all the things, well, because it's a pure currency asset, right? It's the pure thing. And so the moment financial conditions ease, gold moves. And so it's leading everything else, which is, we were kind of thinking, is it leading or is it doing something weird? Is it trying to price in some catastrophic risk? No, it was just pricing in the fall in the dollar. The fall, rates didn't really fall a great deal, but the fall in oil.
And I'd throw on, the visible death of fiat currency as, Western nations drive their deficits and their borrowing levels to absurdity. It seems like that's something gold was reacting to on the way up, right?
Well, that's what the financial conditions are in the end.
Yeah.
It's the debasement of currency. It's the whole thing is the debasement of currency by excess liquidity being pumped into markets by any mechanism possible. At first, they used the balance sheet. Then we all figured that out and called that money printing. So then they did this Fed net liquidity trick, which was the balance sheet plus the Treasury General account and the reverse repo. Yeah. Then we figured that out. And then they moved to total global liquidity, which is including M2, which is stuff it on the bank's balance sheets. So force the banks to buy bonds. That's the game.
As Raoul Pal outlines, we may be standing at the precipice of a major shift in financial markets, one that echoes the past but moves at a dramatically faster pace. His observations paint a picture of a market being quietly restocked by the largest pools of capital in the world, sovereign wealth funds from the Middle East, U.S. pension giants, and institutional banks all gearing up to deploy capital into crypto and equities. What's changed is not the technology, but the clarity. Regulatory signals from the U.S. are finally giving these institutions the green light to participate at scale. Yet many asset allocators still don't understand what crypto is. Some remain paralyzed by volatility, while others struggle to classify it within traditional frameworks. Pal argues convincingly that it's no different from previous market revolutions, like the launch of the GSCI for commodities or the gold ETF. Each time, volatility scared the crowd, and each time, early movers gained the edge. Now, that same dynamic is playing out again, but this time with crypto as the disruptive asset class, accelerated by macro tailwinds. At the heart of Raoul's thesis is a data-driven framework where financial conditions, namely the dollar, oil, and rates, lead macro outcomes. Liquidity follows, and then risk assets respond. Bitcoin, he finds, trails global liquidity by about 3 months. Gold, in contrast, reacts in near real time. Why? Because gold is a pure monetary asset, sensitive to shifts in currency debasement and financial repression. As governments run unprecedented deficits and central banks manipulate liquidity through increasingly complex mechanisms, markets are reacting not to noise, but to deeply rooted structural shifts. And that's the key insight. This isn't just a rally based on hype. It's a function of a global system awash with liquidity, a generation of investors still underweight, and a growing realization that inflation, rates, and geopolitics are no longer headwinds, but background noise in a larger monetary transition. Whether we're about to witness a repeat of 1998's V-shaped recovery or the early days of another 2017-style bull run, one thing is clear. The market is moving, and the smart money is no longer sitting still. Liquidity is rising. Sentiment is still cautious. Positioning is light. And history shows, when that combination appears, the market doesn't wait. So the question is, are you ready? Are you positioned for what's coming, or are you watching from the sidelines while institutions quietly take the lead?